Hey everyone, Doug Smaldino here. Happy Wednesday. Hey, I just want to put out this ad hoc video. You guys have probably heard by now that the Federal Reserve made a pretty aggressive rate change today, increased the federal funds rate by 50 basis points, basically 0.5%, which is the largest increase in 2 decades. So here's a little snippet here. Let me just switch screens here and show you what it said on CNBC. There we go. So basically, we're looking at right there. Federal Reserve raises rates by 0.5%, and that's the biggest hike in 2 decades to fight inflation. So obviously, people are calling us a little freaked out and want to know what is going on. And as you can see right here, it's a little bit, doom and gloomy, as it says. Now, keep in mind that the federal funds rate is only one of the indexes. It doesn't necessarily have an impact on anything, especially on us in the mortgage and real estate business. So basically, I made a couple notes here. So the federal funds rate, here's the confusion. Here's just a couple bullet points to keep in mind. Federal funds rate, that is the rate at which the Federal Reserve lends money to member banks. Your big banks, your Chases, your B of A's, your Wells Fargo's of the world. The federal funds rate is the rate at which the Federal Reserve lends to these member banks. The member banks, in turn, lend their money to the consumers, and that's called the prime rate. So you've heard these terms before, but it's just a lot of technical terminology, and you're not sure what it means 100% of the time. Basically, when the Federal Reserve raises the federal funds rate, it does impact stuff like equity lines of credit, credit card debt, auto loans, and other consumer loans, okay? Business lines of credit absolutely impacts those. The idea of the raising of the Federal Reserve, of the federal funds rate, is to slow down the economy. Like businesses think twice before they just draw, millions of dollars on their line of credit so they can, invest in their business. Okay, so that's the whole idea. The price of money gets a little more expensive, causes businesses to rethink things and slow down, and that's the Federal Reserve's best tool to slow down an overheated economy. Albeit, I think it's temporary, but that's just the facts right now. So basically, it has no impact on mortgage rates. For example, and also, the rate, it's kind of like bad news, but it's all factored into the markets. The markets have already had this factored in for months. In fact, the stock market was up today over 900 points, and mortgage rates were down today. Okay, so this is not a bad thing. This is just, hey, this is the federal. It doesn't mean that, hey, the economy is going to collapse and we're going to see, housing prices fall like crazy. Absolutely not. Absolutely not. So the only thing it really affects with mortgages is home equity lines of credit. So that's the thing. So basically, clients get a little panicked these days. Basically, they're hearing a bunch of stuff and getting a bunch of advice from quote-unquote friends and experts. It's basically meaningless for today. There might be some more raises later in the year, but it won't have much impact also because those are already pretty much factored into the market. And so what do you tell clients? Tell clients, look, just work with professionals. Work with people, top advisors that know what they're talking about and that are going to give you sound financial advice. Not the greatest advice that they always want to hear, just the facts. But right now, all this doom and gloom out there, it just isn't real. And I think consumers need to hear the straight scoop. Have questions, give me a call. Thanks, guys. Don't worry about the federal increased rates. Have questions, call me. Happy to help. Cheers. Have a great day.